Welcome back, and joining us for a closer look at what moved markets today is Makwe Masilela from Makwe Fund Managers. Thank you so much for your time, Makwe. One thing that I did notice was that the rand strengthened today, of course, after reaching about 19 rand 20 against the US dollar sometime earlier this week. Is it all that South African inflation for December that came out less than what markets had anticipated?
That as well contributed, and yes, we were expecting 5.2%, but also remember that the rand itself is a commodity currency. So with that announcement that China will be coming with stimulus, we've seen commodity prices going up, mining stocks benefiting. So as a result, the rand benefited from that as well. And not forgetting as well that the US dollar has been drifting lower as well. And now also that continued to benefit the likes of the rand. But anyway, I guess equity players are somehow in a very sweet spot.
Yeah, well, something that rand is strength, something that the MPC will also be celebrating. And I'm wondering if any of these moves, the rand, also the inflation figure that that was released today, if any of those have changed your thinking in terms of what the Reserve Bank could do tomorrow.
You know, we know that they want to fight inflation, and yes, we've seen inflation have managed to go down. We know they want that to be anchored, especially when you look into inflation expectations at anything around 4.5%. So at least we are getting there. But also, they need to maintain that interest rate differential with most of our trading partners, and with them continuing to hold interest rates, and probably they'll continue to do that even the next meeting that they'll be having. And then also given that locally we can see that consumer spending is no longer that great. So I think our Reserve Bank will probably continue to hold rates, and that will be the fourth meeting in a row.
Yeah. Well, talking about consumer spending, TFG, the Fashidi Group, came out with its third quarter trading update, talking about turnover growth, but really also still lamenting the challenges that do exist in the environment. We did see that share price surging more than 5%, and I'm wondering what investors held on to there.
You know, we know that they've been having issues when it comes to load shedding. We know that Black Friday didn't do that great for them, but was partially offset, you know, by the festive trading. And bearing in mind that that weekend of Black Friday, we had the stage 6 load shedding, and the port's inefficiencies definitely affected the flow of inventory. But fortunate for them, they've got local manufacturing facilities that help a little bit. And I think also what was encouraging, I mean, the cash turnover increasing by 15%, contributing almost 74% to the African sales. I think that's a good thing. And the credit sales just up only 2.3%. And look into the acceptance rates of new accounts, you know, continues to be just okay. You know, I think it's around 17.8% or so. So I think markets are saying going forward, the guys are not doing that badly.
Yeah, well, it's a high tide lifts all boats. That's how the saying goes. Was this the trend today? Because, of course, we saw TFG's share price surging after that trading update, but also then we had this better than expected inflation print. And then Woolies also we saw there in an upward trend after being under pressure yesterday. Would you say that that was just the tide lifting Woolworths today?
Definitely it was, and not forgetting that Woolworths Food managed to do well, you know, managed to show the strength and the resilience. And we know when it comes to the fashion and home and beauty, that was unfortunately affected by the ports issues. But generally, I think the guys are doing great, and fortunately for them, they've done away with that trouble baby, the one that they owned in Australia, that
all right. Just before we get to your stock pick, let's talk about Quilter. It also released its fourth quarter trading statement saying that assets under management and administration increased by 5% in the fourth quarter from the third quarter, saying that it reflects a positive or rather supportive market. And I'm wondering if this is maybe the start of a turnaround in terms of the asset managers and the supportive markets.
Not necessarily, because if you look at that, the market started improving mainly from November or so, and that's after people started to entertain the narrative that come March this year, we'll see interest rates having to be decreased. So we saw a lot of people piling into that. Even our local markets did well, rush into what we call Santa Claus rally. But now the question is, going forward, there'll continue to be a lot of volatility. We've been seeing that tomorrow, expect some GDP numbers from the US. We're also expecting some inflation numbers. The point I'm making is that volatility will continue to be there. So I don't think one can just read from that one set, to say that things have turned around. The question here will continue to be, when will interest rates be decreased by most big central bankers?
All right. Well, let's get to your stock pick for today, Makwe. What will it be?
I'll go for a retailer, which is Clicks. We've seen their 20-week trading update that the guys, for the fact that they've managed to do well when it comes to the festive trading season, that also helped them to gain some market share, and mainly in their core products. And we've seen that their retail sales were up almost 11%, and the wholesale sales, we know that they were affected by that system transition, especially when it comes to that main distribution center at UPT. So yes, at a dividend, at a PE of 28, you can say it's priced for perfection, but it's the same like their competitor, but they are a good dividend payer because they've got a dividend yield of almost 2.3%.
All right. Well, thank you so much for your time and for your insights on what has been driving investor sentiment today, Makwe. That was Makwe Masilela from Makwe Fund Managers.